What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Spencer Jakab and Andrew Left. Spencer is an award-winning financial journalist who edits the Wall Street Journal's Heard on the Street column. He is also the author of The Revolution That Wasn't, a book about the meme stock craze that overtook the video game retailer GameStop in 2021, and the heroes and villains, like activist short seller Andrew Left, who made that story so captivating and powerful. As the founder of Citron Research, Andrew famously bet against GameStop during the mania of 2021, only to get squeezed out of his position as the stock rallied to the unimaginable heights of $483 per share. Last week, amidst the excitement and uproar of Keith Gill's anticipated return as Roaring Kitty, the hero of Wall Street bets and the face of the GameStop meme craze, Andrew announced that he was at it again, taking a new short position in the video game retailer, albeit at a significantly reduced size from the one he was forced to close 3 years ago. We devote the episode's first hour to recapping the GameStop meme craze and how it relates to the concept of financial nihilism that I developed in 2019 and began publishing episodes about in early 2020. We discuss the role of narrative investing, the characters that make up a good financial story, and how those character archetypes come together to generate interest and excitement around a given company's stock or an otherwise worthless crypto token in the hopes that it could lead to life-changing profits, a communal sense of belonging, and a whole lot of fun. I ask Andrew and Spencer in the second hour if they think that this latest resurgence in the price of GameStop is a late aftershock to the 2021 mania, or if it is a sign of things to come as we ramp liquidity ahead of the 2024 election. I also ask Andrew about how this investment philosophy of financial nihilism has impacted the ability of activist short sellers like him to operate, what he thinks explains this change in attitude towards the stock market among millennials and Zoomers, and how the forces driving it are impacting our politics and society at large. If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this timely and insightful conversation with my guests, Spencer Jakab and Andrew Left. Spencer Jakab and Andrew Left, welcome to Hidden Forces.
Thanks for having me here.
It's great having both of you. Spencer, this is your second time on the show. You were on, was it the summer of 2021 that you published your book on Wall Street bets, Reddit, and Robinhood, and what you called at the time the revolution that wasn't?
Yeah, it still wasn't. The book came out actually on the 1-year anniversary of the crazy squeeze, so in January 2022, and we spoke a few weeks after that.
Okay, I had it in my head somehow that it was in the summertime. It was a great book. I remember reading it, and it offered a lot of insights about the subject that we're going to talk about today. So anyone who had read that book or heard that conversation, I think would have been better prepared to kind of have some context for what's been happening the last month, really, with the reappearance of Keith Gill and I wouldn't call it I don't want to use a judgmental term pump, but the rise of Wall Street bets stock price again, which had been trending down really since 2021. I want both of you guys to introduce yourselves. Spencer, why don't you just give us a quick background, for people who don't know who you are? And then Andrew, I'd love for you to also do the same.
Sure. Well, I'm a financial journalist. I'm the global editor of Heard on the Street, which is the Wall Street Journal's home for financial analysis and commentary. And on the side, I also have written a couple of books, most recently about GameStop mania.
I am Andrew Left. I am the editor and founder of Citron Research. I am probably now what's maybe the original activist short seller newsletters. I think I started it around 23 years ago. And it's been an evolving industry. So I'm one of the grandfathers of activist short selling.
So Andrew, this is, you guys fit in the narrative of GameStop because this was, something else that Spencer and I talked about. And we live in the world now where a lot of people feel like everything is just a narrative. And this has infiltrated into the world of meme stock investing. And nothing makes a good narrative like you need a hero, but you also need a villain. And the shorts were the villains of the last cycle in 2020, 2021. I remember we talked about Gabriel Plotkin of Melvin Capital because Melvin featured really prominently in that story. Where did you fit in all of that?
Well, so Gabe Plotkin was obviously, he was short the stock with his fund. I was also short the stock. And the day that the whole thing erupted, I put out an article and I made a video. And at the time I'm like, normally if I make a Twitter video, it would get 15,000 people, 20,000 people. So I signed on that morning, much like I'm on with you, and I thought my machine was broken. It was like getting 450, 500,000 people. I'm like, really? What's happening here? That's when I realized it was something bigger than just what I was involved in. So, I put it out anyways. And then by doing that, unfortunately, the video allowed me to be a face in the camp of the enemies. And all I was doing was just talking things that were rational about the stock. But, nobody wanted to hear rationality back then. So, put that out and then, the rest is just Wall Street history.
Can you share any other details about that? I mean, you reportedly got squeezed out of your position. I mean, were these significant losses that you encountered?
So there's a lot to be said with that. First of all, going back to the kitty, if people remember, in August, he put out a premise, his video about why he wanted to buy GameStop, about a turnaround of the company. Come December, there was an upgrade cycle in the video game console business. And come January, we got the data out that they were not the beneficiary of it. I was simply stating the data. I mean, it's silly for me to confuse facts with a good story, that GameStop's business did not inflect as expected. So that's the first part of it, what the contents was. Did I incur a loss? Yes, I did. At one point, a journalist said to me, did you lose money? And I said, yeah, 100% I lost money. The next thing I know, the headline said, Left loses 100%. So be very careful whenever you speak to a journalist and how things can get twisted around. Your friends are calling, do you lose everything 100%? No, 100% I lost money. I was very fortunate as a professional short seller or trader, investor. I cut my losses. Now, I did incur significant losses, but nothing that was going to change anything. The Left family, the kids stayed in private school and everybody ate nice that night. Nothing changed. But, it's what happens when you short stocks. You run those risks. With this particular circumstance, once it became completely removed from reality, the trading, that's when as a short seller, it's out of my realm. I'm not going to fight this one. The negative rebate became 400%. They raised for the margin requirements. And who knew? I just didn't want to play that game anymore. So on its way up, I think the stock was around $90 a share.
I think the peak was 483. Am I remembering right?
483 that Thursday, yeah.
Yeah.
Which is probably the greatest trade I ever made, was taking one of the biggest losses I've ever made. Because if I didn't cover it at 90, I would have woken up 2 days later. It would be 250. And the margin requirement gets raised out, and that's how accounts get cleaned out.
That's funny. I was about to say, you sound like a Wall Street Bets degen, taking credit for your massive losses. So we're going to have a chance later, Andrew, to talk a little bit about how this short selling industry has changed, how this has impacted your willingness to take risks. This is something that fascinates me. Spencer, given the fact that you've written a book on this subject, I'd love for you to, just kind of recap this story overall for those who need a refresher. Even I needed one. I needed to go back and actually look at this. I'd even forgotten about Robinhood. I mean, there's so much stuff that gets thrown at us these days that it's easy to forget. And then I'd love for you to catch us up on what's happened in the last month, especially between May 10th and May 14th, when we really saw this giant rise in the stock of GameStop. And then subsequently when Keith Gill came back and did a live stream. So start us off with that. One, recap the whole GameStop story. And then two, what has happened in the last month that has caused a resurgence in the price of the stock?
Sure. I'll try to give you the Cliff's Notes version of what happened. And just for anyone following along and then checking GameStop's share price, GME, on their Yahoo Finance or their Bloomberg, you will not see it ever having hit $483 because the stock has split since then. But that was the peak that Thursday, still the all-time peak. It went from $2 the previous spring to $483 at its peak. So I think to understand the story, one has to put it into context, and just really condensing this, in 2019, every major retail stockbroker went to $0 trading, to free trading, which I think was a very important element in this. Robinhood was not the first to do it, but was the pioneer. Robinhood was the primary broker that was involved in this, and that was sort of the conspiracy theories kind of swirled around it because it halted purchasing of GameStop at the peak of this. And we can go into why that happened. That's still shrouded in controversy as well. It's very clear what happened. Then you had the pandemic, then you had stimulus checks, then you had interest rates go to zero, stocks crater and come back. You had a lot of young men getting into sports gambling around this time because it was legalized in many states. And then all of a sudden sports disappeared. And you had more than 10 million retail trading accounts, mainly opened by young people during that period. So you had a huge influx of people who were excited by the wild gyrations in stocks in 2020 and early 2021. If you looked at the most shorted, most frowned upon stocks, those are the ones that did best. A basket of the most shorted stocks rose something like 200% in the span of less than a year. 94% of stocks from the pandemic bottom to a year later rose. So it was almost impossible to pick a loser, and it really made people feel like they were unstoppable, people who were brand new to the stock market. And then you had this whole meme stock phenomenon start, and probably arguably Tesla was the original and the OG meme stock. But GameStop came to some traders' attention because it was a loser of a company, along with a handful of other companies. There was really no way to make a fundamental argument that it would recover or do well. It had lost money for years. And so the short interest in that stock was very high. And one reason the short interest, the short bets, the bets that it would decline were so high is because it was so dangerous to pick any of the glamour stocks, outright frauds like Nikola, to bet against them because they would burn you. And so GameStop was seen as safe by these short-selling hedge funds and long-short funds that had some short positions, like Melvin Capital, which was a $13 billion hedge fund at that point, is now out of business. And that they laid a trap for themselves. And Andrew, as I wrote in the book, his tweet, events were well on their way to getting crazy, and he just kind of threw blood in the shark-infested waters and arguably, made it crazier because he put another face on it and used social media. I mean, Gabe Plotkin at Melvin Capital never went on social media to do this. Andrew, who we spoke a few times after these events in the immediate aftermath of them, with his tweet directly challenged the meme stock traders and told them they're the quote unquote suckers of the poker table, and that enraged them. And there was nothing that these people hated more than hedge funds, and specifically short selling hedge funds. And so he was this sort of cartoon villain for a while, took over from Gabe Plotkin during this time. And this movement pushed GameStop through the roof through the use of many small accounts using kind of weapons of mass destruction, which were financial derivatives, bought expressly not to make money, really, but bought to have the maximum effect on the stock with the minimum amount of money committed.
These are the zero-day options that were used.
Well, at that time, there were not zero-day options, but they were because those didn't exist for individual stocks. But you have effectively a zero-day option if you're buying a stock that expires, an option, call option that expires within days. So a very, very short-dated, out-of-the-money option. You have the maximum ability to execute something called a gamma squeeze, where basically you may have $200, but by buying $200 worth of options, if you and many of your friends do it at the same time, the options dealers just mechanically, they're not making or losing money on this. I mean, they're making a lot of money off of you, off of your premium, but they are hedging the other side of the bet. They have to go out and as the stock rises, they have to purchase a bit of it. And as it rises closer to the strike price, they have to buy more of it. And so your $200 purchase might turn into a $20,000 purchase of stock by them up until the option expires. And it becomes a self-fulfilling prophecy. And then if you're a short seller like Andrew or like Gabe Plotkin, that causes distress and causes you to close out your short position. Since you never bought the stock, you only sold it, you borrowed, or you located a borrow, and you only sold the stock. In order to close out your position, you also have to buy it, which is a classic short squeeze. And so this didn't quite turn into a corner, but that's what they were trying to effect. A stock corner is when you buy so many shares that short sellers have to pay any unlimited price. They're completely at your mercy, that they will go bankrupt if they don't pay any price you name. That was what was being attempted. And that's what initially got me interested as a financial journalist in this story. I knew that I had to write something about it, and eventually a year later turned into my book.
There's so much that hasn't been said financially about this story. And what upsets me the most, people say to me, why do you keep talking about it? And I say, I want the true historical reflection. First of all, if you watch that movie, the Ben Mesrick movie, The Dumb Money, which I thought was just ridiculous, and they make it as if Gabe, Ken, and Steve are like these buffoons. I mean, let's put it this way. Since the GameStop fiasco, Gabe Plotkin bought the Charlotte Hornets, Steve Cohen bought the Mets, and Ken Griffin buys anything in this country that's not nailed down. Every piece of expensive real estate, art, whatever it may be. So everyone's doing just fine. The second thing, and this is a major thing, and this goes to the trading. Well, first of all, I want to put the zeitgeist around the time. This happened 2 weeks after people stormed the Capitol building. So there was an angst amongst people. There was some kind of anti-establishment, feeling in this country. It was just, it's at the same exact time that Biden was coming into office, literally, I think within the same week of his inauguration. But when GameStop had the trading that was going on, and when it got halted, people don't realize something. I remember the day when it was 200, 250, 300. It was trading 200, and a $200 call that was expiring in a week was trading for $100. When it was trading 300, a $300 call expiring in a week was trading for $150. Now, in order to make that trade, you have to post 300% margin. It's the easiest trade to sell that call. But there's probably only two people in this country who have the bank account to do how much they wanted to. And that would be a Citadel and a .72, a Ken Griffin and a Steve Cohen, those type of people. When they halted trading in the stock, they were saving people from buying those sucker options. Ken Griffin could have made any kind of money on that by just selling those options. So you understand, it was stock's 300, and the $300 calls at the money calls expiring in 1 week because people didn't want to pay $300 for the stock. They'll rather buy the calls. Newbie stock traders can't understand the difference. They're paying the premiums on this optionality. The volatility was off the charts. So there was no, we had to stop trading because this is not a coin. If you saw what happened the past 2 days, the company could just issue shares, put a registration statement. There's not a finite amount of supply of stock that can come out there. It might have taken the company a week, but that's fine. Who benefits are the deep-pocketed hedge funds, the higher the stock went. And it was never really told properly that way. I do believe the steps made by Robinhood were the right steps to curb. You want people to invest in stocks. Yes, there's gambling involved, but this is not DraftKings.
But isn't that what Robinhood was? It was an app that was built precisely to try to lean into the gambling impulses of people?
Well, I don't know. I mean, I use interactive brokers, and when my trades go off, I still get ding, 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 like it's a slot machine.
Well, you don't get confetti. You don't get confetti shots that come out every time you buy something.
No, but you get those dopamine sounds, the ding, 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 ding. This really, and that's interactive brokers. Yes, the confetti was a bit extreme by them, okay? People took that confetti and bought congratulations, you just bought Apple. It wouldn't be so bad.
Yeah, I'm going to just jump in for a second there. The Robinhood app was consciously designed. So they designed an app first, and then they built a broker behind it. It was app of the year when it came out. It has the fonts and the colors and many other things very closely resemble gambling phone apps for a very good reason. Because when you open up the Robinhood app, what does it show you? It shows you what stocks are trending, what stocks have gone up a lot or down a lot that day. Why is that important information to you as an investor, as to an investor who hopes to make any kind of a prudent long-term investment? It isn't. It induces FOMO. It induces excitement. The app was built to engage people. And in 2020, the average active Robinhood user checked the app 7 times a day. A day. If you check your brokerage account 7 times a month, you're already harming your returns. If you check it 7 times a day, you are a degenerate gambler. There's no reason to check your brokerage account that often unless you are, have an unhealthy obsession with the, line going up and line going down. And just want to make one clarification, not that I'm on his payroll or his defender, but Ken Griffin, Citadel has 2 different businesses, and that this is what caused a lot of confusion in the public, and it continues to cause confusion in the sort of the audience that embrace these meme stocks, is that there's Citadel Securities, which at the time he owned 80% of, and unfortunate that he called it Citadel. And then there's Citadel, the very large hedge fund that he presides over. And it was Citadel, the group, that gave Gabe Plotkin some money during this time. And so he was seen as being in cahoots with Gabe Plotkin when he needed a bailout. It was a very profitable bailout. It was, kind of a revenue investment for him. Citadel Securities is the part of the business that made lots and lots of money simply by being a middleman. And that was the point of my book, is that Wall Street, Gabe Plotkin did not do. Gabe Plotkin lost a lot of money for his investors, so it was not a good week for him. But it is a myth that these guys stuck it to Wall Street, because Wall Street writ large, with the exception of a few hedge funds and I guess Andrew's fund and a few others, but they did very, very well because excitement and activity and hyperactivity is a bonanza for Wall Street. It was a record quarter for many firms on Wall Street and for the options dealers and for funds that just happened to be in the right place at the right time, and for executives who were kind of failing executives, people like Adam Aron from AMC. AMC was headed for bankruptcy within months and turned it around, and he greatly enriched himself. The executives at GameStop, the CEO of GameStop at the time, who was almost certainly on his way out, he was the 6th CEO in 5 years at the time, and the company continued to lose money, cashed out with a package that was worth as much as the entire value of GameStop before this began, which is crazy.
So, Spencer, how much of this, given the fact that you did extensive reporting on it, how much of this was about, do you think, the money, making money, and how much of it was about this thing that we're talking about, this desire to send a big FU to Wall Street and to anybody else?
Yeah, if you look at the sort of the very lively folks who are on these message boards and you suggest that it was about making money, they said, no, it was a movement. If you say, no, it was a movement, they say, no, I made a lot of money. So the truth is that they're not a monolith. There were people in any large group. You have people who are early to it, I think, who were in it almost purely to make money. The people who got the ball rolling early, and probably some of the individuals who actually, if they were smart, made money in the initial squeeze, saw an opportunity, read about it online, got in, and I hope for them, got out with a healthy profit, didn't hold on too long. Like any movement, any kind of religious movement or political movement, the late adopters are the most zealous. And so you had a lot of zealots later on who were all about sticking it to the man. They didn't care if they lost money. They weren't betting a lot of money. It was a lot of money to them, a few $100s if you're a 23-year-old guy living in mom's basement delivering pizzas or whatever. But it wasn't a lot of money.
Or someone like Andrew getting pizzas delivered to you in the middle of the
night.
night.
Yes.
Everybody seemed to like that story.
There was a pretty vicious kind of doxing movement. Andrew and a lot of other, and Gabe Plotkin and other people involved in this. Even months later, as I wrote in the book, there was a reporter at MarketWatch, poor guy, who was chased off of social media. He wrote a thing saying, I guess that morning was in April after the initial squeeze that GameStop fell 20-something%. And some timestamps on some brokerage services picked up the MarketWatch article and put it as 3 hours earlier, I guess because he was on the West Coast. And so it looked as if he had written the thing before it had happened, and then was this is like the dumbest thing ever, right? I mean, obviously there's a very innocent explanation for it. He's not a Nostradamus or a time traveler or being tipped off. You don't, your editor doesn't let you publish an article about something that hasn't happened yet. And he was chased off of social media. Anything that you said was seen as a conspiracy. But yeah, later on, as you spoke about in other podcasts of yours, Demetri, it was a totally nihilistic thing, which is unique. You can't go to 1929 or 1987 or 2000 and say part of the financial craziness was just purely to sort of cause chaos in the system or nihilism. And it was this time. And that's one thing that made this totally unique.
But people, what's crazy is you can't even argue or discuss it because, what's the expression? Never argue with a crazy person in public because a bystander won't know who the crazy person is. So when one side of the argument is the stock is overvalued, their financials are deteriorating, they can't execute. And the other side of the argument is Wall Street's one big conspiracy. Okay, where do we go with this one?
Mm-hmm. So, Andrew, I mentioned the pizzas that got delivered to your house. What was this experience like for you? I mean, was this completely outside the realm of anything that you could conceivably imagine happening to you at the time? And what was it like going through all of this in real time?
They never made it past the gate. I live in a gated community, which is fine. I'm going to tell you what I've learned since when it happened and what I've learned since then. People are very mean online. People say mean things when they hide behind their computers. When you meet people in real life, they actually happen to be a lot nicer, which is kind of weird. I've met a lot of the GameStop shareholders, and then afterwards they realized, oh my God, Andrew left. And then they just can't wait to talk to you or ask questions and be. But online, people are mean. And they'll hide behind, yes. And then some people at the time did believe when the stock went down, if you believe the conspiracy theorist, it was the short seller's fault. And it wasn't me as much as my kids. Sometimes they reached out to my kids online, said some mean things. But, if it was like 2 or 3 people that said mean things, you can't categorize a whole movement over 2 or 3 people. But it'd be weird how low people go. It's just the nature of, we've become, and we're almost still there as a country. We're just so divided in the way we express our opinions towards the other side. There's no intellect, conversation involved. You're black or you're white. So at the time, that's how it was with the GameStop thing. Yeah, it was unsettling. When you get emails and they make memes of your face and they do funny things, stupid things to it, just to see it looks bad. And, and I could take it. I have thick skin. I've done this for a long time. But when you see these memes online and what they do and your kids or your wife see it, it's not settling.
I can imagine. I mean, so when Spencer and I spoke, 3 years ago, whatever it was, one of the things that I highlighted at some point in order to help listeners understand this larger point about narrative, because I remember one of the things we talked about, Spencer, and I think you even wrote this in your book, is that it's all just a narrative. And maybe you didn't use those words. I've used those words before, that that we live in this age now where increasingly it's narrative driven. The first area where I saw this was in crypto years ago when I used to be on some of these Reddits like Wall Street Bets or The Donald, and either posting episodes that were relevant to people in the forums or just kind of lurking. There was a hero character, in this case Keith Gill. There were villains like Andrew and Gabe. There was the participatory audience, which was kind of like the alt media, sort of both participating through social media, but also creating the narrative. So a great example of that is David Portnoy. And then you had these populist billionaires like Elon Musk and Chamath. And it's interesting that Andrew brings up the 2020 election. I mean, you brought this up, Andrew, in the very beginning of the conversation, which is that this is around the time that Biden was getting inaugurated. And you just said again that we're kind of seeing some of these things also. And I couldn't agree more, because I feel like there's this really strong populist sort of vein that runs through Wall Street Bets, the same one that runs through the elections. It's the same reason that I've referred to this for so long as financial nihilism, because I feel like that same nihilism that we've seen on Wall Street Bets and elsewhere with loss porn, people posting insane losses from their account, is a similar kind of nihilism that we've seen in our politics. And that in both cases, there's this desire to kind of burn it the F down, whether it is, putting your own financial health at risk in order to take a YOLO bet at sticking it to the man, to the shorts. There's the same kind of, I think, attitude around the elections and a desire to, let's say, put Trump in office, even if it doesn't work out for you personally. You don't know whether it'll work out, whatever. But my point is, at least you get to throw a Molotov at the White House. At least you get to stick it to the man.
It doesn't make sense. And this is the non-political, is we elect Trump to stick it to the man without realizing that Trump is the man. Do you not look at the top of the building? Have you not seen what his apartment looks like? Have you not seen his own personal plane? But we're sticking it to the man by electing the man. Similarly, as you were saying, we're going to stick it to the man by allowing hedge funds to make money on GameStop and sell the volatility. None of it makes sense, but why ruin narrative with something that makes sense?
What was interesting too politically was in the aftermath of this. One thing that I didn't get to when I recapped the history was that on the peak of the mania, Robinhood was told that, because so many of its customers were making the same bets around the same 6 to 8 stocks all along, that it had to post collateral to the DTCC. DTCC is basically part of the kind of government clearinghouse that makes sure that brokers don't go bust, that they can pay each other. There's a settlement period when shares have been bought or sold, but the money hasn't been delivered yet. And they were told to come up with $3 billion in 4 hours, which was impossible even for them during that very frenzied time. They did raise some money that day, but they basically said, look, we're going to halt trading in these stocks. Right now, we're going to not allow anyone to buy, only allow sells. And can you bump it down a bit? And they basically barely covered the amount, but that turned into a outrage that they halted the ability to purchase. And then some other brokers also had to halt the ability to purchase, where, some Robinhood was the main vehicle, the favored vehicle of the Wall Street bets crowd. And then it turned into a kind of outrage where late night TV hosts and then politicians came in. And you had everyone from AOC to Ted Cruz to Donald Trump Jr. to Josh Hawley chime in. So from the entire kind of to the left, to the right of the U.S. political establishment championed this cause of these traders who weren't allowed to buy more GameStop, when there's a very clear explanation.
It's the only thing AOC and Ted Cruz have ever agreed on. It was amazing to me is that people should be able to buy GameStop at $250. This is where they're going to meet. This is where we're finally going to agree. It was beyond.
Well, isn't that the populism? Isn't that really appealing to the crowd? And that's something that's become a more powerful,
unfortunately,
a bigger source of political power in the world.
Is when I think it was Maxine Waters, I don't want to say the wrong politician, who asked Vlad Tenev from Robinhood if they give back losses after people lose money.
I never heard that. Is that right? I don't remember anyone saying that.
They're questioning, so do you give back? It's like, oh God. Yeah, it was just a big wave of populism.
So let's bring us up to date, Spencer. You did a great job bringing us up to today, to the last month. But what has happened in the last month, beginning, I guess, around May 10th, but perhaps there were things that were brewing earlier. I also want to ask you where these conversations are happening, because I did spend some time on Wall Street Bets. I haven't seen any posts there. I don't know if these types of posts have been banned for a long time, but I did go on 4chan and they have been posting for a while. So bring us up to date. And also, what are the forensics here? How did this whole new sort of cycle and interest in GameStop develop?
Mm-hmm. Well, I was asked a lot at the time. I mean, in the weeks, months after, just as I was furiously working on the book and getting it out for the 1-year anniversary of the events, do you think this is going to happen again? And I said, absolutely not, because you had such a confluence of events to cause this to happen. You had 5 or 6 things all collide, with the pandemic, with free trading, with the sports gambling, with the bored young people, with the market going crazy, and then the kind of dangerous level of short interest. And now hedge funds are much more aware today of not being ambushed, where they pay services or have services themselves to take very seriously what's going on in social media and not be blindsided. So I don't think this specifically will ever happen again, but there have been many echoes, even before this recent uptick involving Keith Gill and GameStop specifically, of upsurges in selected meme stocks. You had Bed Bath & Beyond, you had AMC, you had a couple of surges in GameStop itself. And so you have had echoes and ripples of the original one, because once something happens, once your friend has made a lot of money doing something, or temporarily had a lot of money doing something, it's on your radar. It's exciting. It's fun. And so you have a lot of the same people, and even people who weren't old enough, maybe they weren't 18 years old and couldn't have a brokerage account, or they just weren't kind of with it, or were doing bong hits that week and weren't, sort of in on the original meme stock squeeze, who want to be in on the fun. They want to be part of something. even if it isn't profitable, right? So you had many echoes of it. But what has happened recently is that Keith Gill, who disappeared, he last signed off with one post on Wall Street Bets in April 2021 with the final screenshot of his E-Trade account where he showed that he exercised the options that he hadn't sold. He sold about $11 million worth of options at the height of the frenzy. So he turned $55,000 into $11 million in cash. The rest of the options he exercised instead of selling, kind of showing his steadfastness and commitment.
He exercised them in return for GameStop stock that he held.
That's right, yeah. And so he wound up with about $30 million worth of GameStop stock. Didn't make him the largest shareholder, but it made him a large shareholder. And then he kind of sailed off into the sunset. I did expect to hear from him again, but not in this context. So I'm a little surprised too.
So Spencer, I have a question for you.
Yeah.
Do you believe that the money that's on this recent trade is Keith Gill's exclusive money?
Probably, yeah.
So how was he able to turn? So if he made, hypothetically, let's give him the benefit of the doubt and say he made $40 million, which if that was it, GameStop went down since April, since then, but we'll give the benefit of the doubt of $40 million. You pay half of that to the government, right? Now he's at $20 million. Assuming he doesn't spend any money, we know he bought a house, but let's say none of that. And now he just puts up a trade that was $150 million or $200 million. How big? I forgot. $150 million. To put the trade.
$176 million. Yeah. I mean, I guess my question is, first of all, it doesn't matter, Andrew, right? I mean, have you only ever invested your own money that you started with when you were 22 years old? I mean, you manage other people's money. There's nothing dishonest in that. So it's possible that it was someone else's money as well. But he could have been a billionaire in January 2021. Every day, the whole world was tuned in at, kind of 4:20 p.m. He'd do a screenshot of his E-Trade account. And they said, if he's still in, I'm still in. If he had shown at any time during that period, or even in the aftermath, a position in any stock, and preferably a less liquid stock, he could have made $500 million to $1 billion when all eyes were on him, and he didn't. So I don't know him personally. Obviously, I feel like I know him, but I feel like, he understood that he could be the world's most successful stock influencer at that point in time. And he didn't do it, which is surprising to me. It's weird that he's reemerged and done this, because he's made a lot of money on paper. He's made a much larger fortune, whether it's his own money or someone else's money. I think it's his, because he hasn't registered a fund, right? So I think that in the meantime, he made money because he's a pretty savvy reader of the kind of the pulse of this generation. He has a CFA, but he understands these memes, and it's possible that he made a lot of money in the meme stock world or something else. Maybe he bought NVIDIA. Who knows what he did, right? In between, doesn't matter. He has this money and he's now multiplied it again. But he could have been a billionaire at the point that the initial events unfolded. He had that level of influence. He could have done anything.
Was the 176 million the amount that we know he had in June? Like, is it possible that he could have used call options ahead of bought call options close to expiry?
He did. We know that he did. It's been reported
ahead of the tweeting out that image of him leaning forward in the gaming chair.
E-Trade was watching his account, before he made.
So could that explain where all the money came from?
No, I mean, I'm a stock trader. I can tell you how trading stocks works. I mean, let's say, first of all, I have a whole different opinion of what happened. I'm not, you call me a conspiracy theorist. I'm more of a realist. I don't think he turned his $40 million or afterwards $25 million into $200 million. I think if he did, he would have, one, kept his mouth shut, not gone back to GameStop. Understand the new GameStop trade, if he bought it at $20 average, okay, split adjusted, that's 80. So he buys the stock at 80 when his first buy was at 2 or 3. So he's buying the stock at 40 times higher. And he had an investment thesis. It turned out to be wrong, but the stock turned out to be right. And he made videos with his thesis. If he came back the second time, Spencer, and he only bought 10,000 shares, 20,000 shares, what made this story newsworthy was the amount of stock that he bought. That made him, wow, look how successful he must have become. So if, in fact, he said to everyone, I took my GameStop and then I bought NVIDIA, the first question is, why don't you share that with us? And then I took my NVIDIA and I rolled it into whatever he wanted to, okay? I don't believe any of that happened. But let's say he did. And then he went back this time around. He didn't give a reason he was buying GameStop. It made it newsworthy because the size of the trade. And because of that, if that was not in fact his money, but someone else said to him, hey, let's give this a test whirl in May when you lean up in the chair. Let's buy some options. Let's see if you're still relevant. Understand, he could have put that out and no one would have done anything. There's a chance that could have happened also, right? So let's say he did that and he made some money. And then, oh shit, it worked. God, we could still do this. And then they went ahead and some deal was worked out. And I think the reason why his account might have been flagged is there could have been a big deposit in the account. It's just my opinion.
So, we both brought up the case of him leaning forward in a gaming chair, sort of game-oning everybody to know that, he's back, he's focused on something. What's really fascinating about this, besides the whole sort of regulatory component, which is that it's very difficult to decipher intentions or meaning from these memes, it's a fascinating way that younger people have been communicating. And it's a language that's very difficult for older folks to decipher. And I'll give another example because it's been basically on Twitter that he's been primarily communicating, right, Spencer? Again, I'd love for you after I'm done with this for you to answer where else we're seeing stuff. Because like I said, I didn't see anything on Wall Street Bets on Reddit, but I have seen some stuff on 4chan. I also retweeted recently another meme that he put out, which is a picture of the Joker waiting in the beginning of the Batman movie, The Dark Knight, where he's got a mask on his left hand kind of, dropped. It's right ahead of the bank robbery before he gets into the van. And I feel like that is sort of talking about, hey, D-Gens, let's get ready to rock and roll. We're going to go do this bank heist. We're basically trying to get people hyped up. It's a really fascinating thing. I'm curious from your perspective as a reporter who's had to try and decipher this from the top down, right? You didn't come in this from the bottom up. You weren't in these Reddits, as an unemployed young man or as a sort of lonely, quote, D-Gen living in Ithaca, New York, like one of the characters, one of the folks in Wall Street Bet. How did you come to understand what's actually going on here with these memes and this communication and this subculture?
Yeah, well, I have 3 young adult sons, smack dab in the middle of this demographic. Not that they were all over it. 2 of them were actually, on Wall Street Bets and following it. About a year before the events took place, sitting at the Wall Street Journal, pre-pandemic, immediately pre-pandemic, you would see some stock take off. Not a major stock, not General Motors or ExxonMobil or something like that, and nothing stodgy. But some stock would be up 50%, and we'd wonder why. And it's Wall Street Bets, and we'd all have a laugh about it. And of course, the financial world wasn't laughing in January 2021 when Wall Street Bets became briefly the center of the financial universe, right? Where things that were going on there were having a really major, significant impact on a corner of the stock market. So yeah, we watched it, but it was hard to decipher. And as I wrote in the book, Gabe Plotkin's firm was aware that he was being mentioned on this forum, and they did not take it seriously. And I guess I fall in the same camp. I'm a little older than Gabe, but I didn't take it seriously either until it was time to really take it seriously. As I spent a year, at least, buried in this thing and looking back through all the, existing and deleted messages there, because the internet is forever. Everything is still there. And so I really immersed myself in it. And even then, when Keith Gill posted the tweet sitting up in a chair, I was just watching a baseball game with my sons. And the son who originally brought it to my attention said, "Dad, check this out." So he was aware of it. I would have not seen it until hours later, perhaps the next morning. I mean, I'm not tuned into this. I'm too old and square.
But that caused a major rise in the stock, right?
Yeah, but it was on a weekend, so the market wasn't open when it happened. But yes, it caused a major rise. I think there's 0% chance that it would not have caused a major rise. This guy has disappeared. He was this cult figure. He caused this, GameStop became the most traded security on the planet briefly. Mm-hmm. GameStop is this money-losing, retailer. And so, of course, it was going to cause a huge stir. There was no chance. Legally, he is not a stock manipulator. It would be very difficult, for what it's worth, for the SEC to accuse him of pump and dump. And I'm sure he's being very careful about that. What's sitting up in a tweet of person
Exactly.
sitting up in a chair? What are you going to, even the crazy live stream that he did, I don't see anything that he said or did that can be construed as a pump and dump, because we know he owns it, right? He was clear about that. So, what are you going to accuse him of? It's like he has, I think Matt Levine said it, like, imagine you had like a magic lamp and you could, stroke it and make any stock price go up. What would you do? How would you position yourself? Well, that's what he did. He's no dummy. But I don't think that he broke the law doing it. I don't know if we can debate how honest it was. I think it's fairly honest, but it's also a shame, because it's a shame what young people are doing with their money that they could use for other things, down the road, investing it in a more rational way. And it's a shame what's happening to markets, basically also, which is that it's this kind of number go up, mentality of, I'm going to buy something simply because I think it'll be higher later, with no view to why it should go up or why it's a good thing or what asset is backing it. What's the difference right now between Dogecoin and GameStop? I guess GameStop has a business and assets and hasn't made an operating profit since 2017, but at least it's a business. I mean, Dogecoin is just literally started as a joke, and that goes up, right? So that's kind of a shame, and that kind of perverts what markets exist for, both for savers and for the company. The next Apple that might be out there wanted to raise money and wants to get some attention, for its promising product or business.
Well, I think that's what makes the meme stocks craze, ironically so, remarkable. It's that you have some of these businesses with actually underlying revenues, which I think is actually a negative. I think it's a net negative. I think you're much better off having a Dogecoin or something that's like purely worthless that you can just pump as a meme. And that gets us back to this whole point about financial nihilism and investing. I mean, unless you have an actual company with real prospects. And even then, we're back in this sort of crazy world of narrative investing, where a whole generation, 2 generations really, millennials and Gen Z, have lost faith in the stock market. They see it as a casino. They also don't really seem to buy into this idea that underlying value actually has any relationship to the stock price. There's that great quote by Dave Portnoy where he says, it took me a while to figure out that the stock market is completely disconnected from the underlying economy. And I mean, even that, that incredible phase in American life during the pandemic where people were losing their jobs, that they were getting stimmy checks, the economy was in the tank, but the markets were pumping. And then you had guys like Dave Portnoy who were native gamblers who were just yanking on their Zoom stream, and they were just going live and they were providing massive amounts of entertainment. And there is this kind of, again, it's this kind of nihilistic quality of we're all sort of joking around, fiddling while everything burns down. And I don't know. I mean, I've speculated quite a bit on this podcast. I have my own theories about what it's about. Obviously, we're all speculating. It's something I would like to ask both of you guys when we move the rest of our conversation onto the premium feed. And I also want to ask, where does this go for both of you? Do you think this is the beginning of another pump headed into the 2024 elections? One of the things that we've talked about on this podcast is whether or not the Fed is actually going to be willing to continue to keep rates high and keep liquidity tight. In fact, certain folks like Michael Howell, who have been on the show, have made the argument that actually liquidity has actually been loose and that focusing on interest rates has actually been a deceptive turn. So are we getting ready for another pump? And also, Andrew, like I said, man, I'm really interested to hear how this has impacted your work, your industry, short sellers, and how it's changed the way that you approach investing. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Andrew and Spencer, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Guys, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.